Hi guys, in this video I'm going to walk you through how to use the simulator. Here is the simulator tool that is available in your toolbox for silver and gold members of the logical option. I'm going to walk you through a few examples so you can see how best to use this so that then you can take and apply your own configuration and get some results to help you in your binary options trading. So let's first go to the frequency of state percentage calculation. We have three options for you to choose from. I am going to select never right now, and I will give a little more detailed explanation of what that means in just a little bit. So I'll go over to win rate. This is what your expected success rate of the signals you're using to trade binary options is. I am going to put in 65% for now. Initial investment is the dollar amount that you are going to be investing into your broker account to trade binary options. I'm going to put in $500. Number of trades that you're going to take per day, I'll put in 10 for now. Number of days we want to simulate over, let's do 1 month, which is roughly 21 trading days. Percent stake per trade, I am going to put in 10% here. What this is saying is 10% of our $500 is $50. So we'll trade $50 on each trade that we're going to take. Now, I mentioned up here is frequency of stake percent calculation. So since this is at never, that means we're never going to recalculate our investment size. So we're going to stake $50 per trade, every trade, no matter if we win or if we lose, no matter how big or small our balance size is. So we'll just continue to trade $50 no matter what. Now if we go over here, minimum balance threshold, this is what is going to be used for calculating risk in the simulator. So I'm going to put $100 in for now. So what this is saying is if we start with $500, say we go on a losing streak and our balance falls down to $100, we're just going to cut our losses, take the $100 out, count the $400 as lost, and stop trading binary options. So hopefully that doesn't happen, but we do have a stop in there, so if it hits $100, we'll just call it quits. So minimum allowed stake per trade is the minimum dollar amount that your broker allows you to trade. So I'm going to put in $10 there. And then maximum allowed stake per trade similar rate is the maximum dollar amount that your broker is going to allow you to trade. Now this doesn't really matter for this particular configuration since we're only going to be trading $50 every time, but we will need it in a little bit. So I'm going to put $7,500 in here, which is pretty typical. Now return on investment for winning trade is the amount you'll get back if your trade is successful. So say you invest $10 and your return on investment is 70%. If that $10 is a successful trade, then you'll get 70% of that back, so $7 plus the $10 you invested. So you'll end up with $17. So I'm going to put in 75%, pretty typical. It usually ranges from 70 to 85%. So now we can run the simulator and get our results. So here are the results that we got. This is the distribution of the final results that the simulator gave us. So if we look at the legend, there's 3.6% of the time we hit this $100 stopping amount. So at that point, just stop trading, counted our $400 as lost, and walked away. Now the risk of loss in this yellow, so about 0.5%. And then the probability of a positive return in this case was about 96%. So it's pretty good results. We can look at this distribution to kind of see what our expected return would be in this configuration. So kind of ranging in this area is a good estimate of what we'll have. So we have the 50th percentile at $1,900. So that's pretty good. And then you can look at the different percentiles and then the minimum, maximum, and average. So I'm going to direct your attention up here to this frequency of stake percent calculation. So we are going to change this to daily. So before we calculated the 10% of the $500, and so we traded $50 every time. Now what we're going to do is, well, the first trade we'll take is $50, and then we'll trade $50 for that day. So we'll take about 10 trades of $50. So let's say tomorrow, after all of the days traded, tomorrow we're at, say, $600. Now we're going to up our trade to 10% of the $600, which is $60. So we'll be staking $60 per trade for all of that day, and so on. So the next day, say we're at $700, we would be trading $700 for that whole day. Now if we happen to lose some money, let's say we got down to $400, we would stake only $40 per trade for that day. This is a way to reduce some risk. So if you lose money, you'll shrink your trade percentage down, so it'll reduce a little risk. And also, if you make money, it'll help increase some return because you'll continually be increasing the dollar amount that you're trading. So let's run this configuration. Keep in mind the risk percent here and the median. Those are kind of the two key points here. So 3.6% and $1,900. So we'll run this new configuration with all of the same numbers in here, except we're just changing that. So here are the new results. The risk percentage dropped down to 2.4%, and the median went up to all the way up to about $4,100. And now we can look at the graph. Here's the risk and then a little bit of loss. So there's about 5.5% of the time we lost money, and then about 94.5% of the time we made money, which is pretty good. And then you can kind of check out this distribution. Keep in mind the scale on the bottom, because this graph, if you don't look at the scale, this graph actually looks quite a bit worse than before. But if you check out the scale, it's actually a lot better than how we did on the previous simulation. We have one last option on the frequency of stake percent calculation that I'd like to show you, and that is after each trade. So this is after every single trade we take, we'll readjust the dollar amount that we're looking to trade. So we start out at $50 and say we win that trade. So we have $50 times 0.75 is our profit. So we have $37.50 in profit. So now we'll add that to the $500. So now our balance is $537.50. So now we recalculate the dollar amount we're trading. So 10% of $537.50 is, say, we'll trade about $54 the next time. So if we lose that trade, we lose the $54 and we're down to $483.50. So at this point, we've lost money. We're going to recalculate the 10%, and our next trade is going to be $48. So we'll keep doing that after every single trade. We'll readjust the dollar amount we're trading. This can help reduce some risk if we're on a losing streak. It also will help increase our return since we're continually be increasing our trade amount as we're making money. This is a good way to get that exponential return that can become highly profitable. So let us run the simulation and get our results. For the results of the simulation, we have about a little over 1% risk of ruin, and then about 3.5% risk of loss that's above that ruin dollar amount, and then 95.5% positive return. And you can check out the distribution here in the percentiles. So those are the three different options we have for the simulator. I hope this video helped you understand how to use it. If you have any questions, please feel free to contact us, and thanks for watching.